You sign the papers. You own a home. Except you look at the amortization schedule and realize that for the first 10 years, you're basically renting the house from the bank at a premium while they let you pretend you own it. My name is Dave, and I spend way too much time thinking about how mortgage interest quietly turns homeownership into a 30-year lease with extra steps. This is for anyone who just got approved for a mortgage and felt proud, then looked at the payment breakdown and felt sick. If you've ever wondered why your balance barely moves even though you're paying thousands every month, you're in the right place. And if this makes sense to you, you'll probably find the rest of our stuff useful too. Here's what people believe. When you get a mortgage, you're buying a house. The bank lends you money, you pay it back with interest, and over time the house becomes yours. The interest is just the cost of borrowing, annoying but unavoidable. It's the price you pay to own instead of rent. That feels true because on paper, it is true. You do own the house, legally. Your name is on the deed. You can paint the walls, renovate the kitchen, sell it whenever you want. But ownership is a spectrum, and when you owe $350,000 on a $400,000 house, you don't really own it. The bank does. You're just the one paying for its maintenance while they collect interest. The reason this belief persists is because we treat mortgages like they're normal. Everybody has one. Your parents had one. It's just what you do when you buy a house. And because it's normalized, nobody talks about how absolutely wild the math actually is. We accept it the same way we accept that cars depreciate or that phone bills exist. It's just part of life. But let me show you the math, because once you see it, you can't unsee it. Let's say you buy a $400,000 house with a 20% down payment. You're financing $320,000 at a 7% interest rate over 30 years. Your monthly payment for principal and interest is about $2,128. In month one, here's how that breaks down. Roughly $1,867 goes to interest. Only $261 goes to actually paying down the loan. You just sent the bank over $2,100, and you reduced what you owe by $261. The rest disappeared into interest. After 1 year, 12 payments totaling $25,536. You've paid about $22,300 in interest and reduced your principal by only $3,236. You sent the bank over $25,000 and your loan balance went from $320,000 to $316,764. You barely made a dent. After 5 years, you've paid about $127,680 in total payments. Of that, roughly $109,000 went to interest. You've only reduced the principal by about $18,680. You're still $301,320 in debt on a house you've been paying for 5 years. That's the trap. You're paying, but you're not progressing. Here's the second shape this takes, and it's about the total cost over time. On that same $320,000 loan at 7% over 30 years, you'll pay roughly $766,000 in total payments by the time the mortgage is done. That's $320,000 in principal and $446,000 in interest. You paid more in interest than the house was worth when you bought it. You didn't buy a $400,000 house. You bought a $400,000 house on a $766,000 payment plan. And if the house appreciates at 3% annually, which is typical, it'll be worth about $970,000 in 30 years. You made $570,000 in equity, but you paid $446,000 in interest to get it. Your actual net gain is more like $124,000 over 3 decades. That's $4,133 a year. That's $344 a month. You could have rented, invested the difference in a basic index fund, and possibly come out ahead, depending on your market. Nobody mentions that because it ruins the sales pitch. Let me tell you about someone I know. We'll call him Marcus. He bought a house in 2019 for $380,000. Put down 10%, financed $342,000 at 4.5% for 30 years. His payment was about $1,733 a month. He was proud. He was a homeowner. 3 years in, he decided to check his loan balance out of curiosity. He'd paid over $62,000 in total payments by that point. His balance was $323,000. He'd only paid off $19,000 of the principal. The other $43,000? Gone to interest. And it hit him that if he kept going at this rate, he'd spend the next 27 years doing the same thing, sending the bank $1,700 a month and watching his balance drop painfully slowly. So he started making extra payments, just $200 a month directly toward principal. And that small change shaved about 7 years off his mortgage and saved him over $80,000 in interest. But he only did that because he looked at the numbers and got mad. Most people never look. They just pay the monthly bill and assume progress is happening. I know what you're thinking. Okay, but what's the alternative? Just never buy a house. And no, that's not what I'm saying. If you can afford a house and you plan to stay in it for a long time, homeownership can still make sense. But it makes sense despite the interest trap, not because of it. And the decision should be made with clear eyes about what you're actually paying. The counter-argument people give is, yeah, but rent is just throwing money away. Except rent buys you housing with no maintenance costs, no property taxes, no risk if the market crashes, and full mobility if your life changes. Mortgage interest is also throwing money away. You're just throwing it at a bank instead of a landlord, and you're stuck in one location with a giant liability on your balance sheet. Rent isn't inherently worse. It's just different. And pretending that all mortgage payments are building equity when 80% of your early payments are interest is creative accounting. Here's the pattern you need to recognize, and it applies to almost all front-loaded interest loans. The system is designed to maximize how long you stay in debt. The 30-year mortgage exists because it keeps your payment low enough to be affordable while ensuring the bank extracts maximum interest. A 15-year mortgage at the same rate would cost you half the total interest, but the monthly payment would be higher, so fewer people qualify. Banks don't want you to pay off the loan quickly. They want you to pay it off slowly, steadily, forever. And if you refinance every few years because rates drop or you want to pull out equity, you reset the clock and start paying mostly interest again. You're back at square one, paying the bank rent for your own house. It's like a gym membership that charges you $100 a month, but $85 of it goes to facility fees, and only $15 goes toward actually reducing your commitment. You're paying, but you're barely progressing. And the gym is betting that you'll stay subscribed for 30 years because canceling feels like giving up. Or think of it like a video game where you're trying to level up, but 90% of the experience points you earn in the early levels get taken as a tax before they're applied to your progress bar. You're grinding, you're putting in the time, but the bar is barely moving. That's what the first decade of a mortgage feels like. You're working hard, making payments, but the progress is invisible. I remember seeing data from Freddie Mac showing that the average homeowner sells or refinances every 7 years. That means most people never even get to the part of the mortgage where the payments start actually reducing the principal in a meaningful way. They're stuck in the interest-heavy phase forever, jumping from one mortgage to another, always starting over. And the system loves that. Every time you refinance or buy a new house, the bank gets to restart the amortization schedule and collect another decade of front-loaded interest. It's a treadmill designed to keep you running. So here's some questions to ask yourself before you sign a mortgage, or if you already have one. Do I understand how much of my monthly payment is actually reducing what I owe versus just paying the bank for the privilege of owing them money? Am I planning to stay in this house long enough that the equity buildup justifies the interest cost? Or am I likely to sell in 5 to 7 years and reset the cycle? Can I afford to make extra principal payments, even small ones, to escape the interest trap faster? If I rented instead and invested the difference between rent and a mortgage payment, would I actually come out ahead? Or is homeownership still the better move for my situation? Am I buying because I want a house, or because I've been told that renting is failure and owning is success, even if the math doesn't support it? Here's the reframe. A mortgage isn't a path to ownership. It's a 30-year payment plan with interest front-loaded to benefit the lender. Ownership happens slowly, painfully in the back half of the loan, unless you actively fight the structure by paying extra or refinancing strategically into shorter terms. The short version, mortgage interest quietly eats the majority of your early payments. You're not building equity nearly as fast as you think. The 30-year timeline exists to maximize bank profit, not to help you own a home. If you don't actively fight the structure, you'll spend decades paying rent to a bank while holding the deed. You're not failing if this feels overwhelming. The system is designed to obscure how bad the math actually is. Congrats on the house. Now make sure you actually get to own it before you retire. If this didn't help you, but you know someone about to sign mortgage papers or wondering why their balance isn't dropping, send this to them. It might save them a decade of confusion. And if you're wondering what happens when you buy into a neighborhood with an HOA that quietly drains your wallet with fees, special assessments, and rules you didn't fully understand, yeah, that's a whole different mess. What actually happens when that $150 a month HOA fee turns into a financial trap you can't escape without selling? You can see it in this next video.